What is up, guys? Welcome back to the channel. My name is Dave Wallace and I'm here to help you win with money and build your wealth. No matter where you are in your financial journey, credit is going to be a massive tool to helping you to build wealth and to save money. Let's talk about the 6 factors that go into building your credit report. As we talk about these, I want to go ahead and break them down into the amount of impact that they have on your credit report. So we're going to break them down into 3 different categories. One being high impact, which would be the items that have the most impact on your score, medium impact, and then low impact, which is very little impact on your overall credit score. So I hope that you'll stick around because all of these 6 factors impact your score and are going to drive it over your lifetime. But if you only did one thing, the one thing that you have to know is that the high impact category makes up 65% of your credit score. So these 3 items that are considered high impact are by and large the biggest drivers of your credit score, and therefore if you're trying to improve your credit score, knowing these items and working on these items, that is the best place to start to get the most bang for your buck and driving your score up as quickly as possible. So let's dive into the video. Number 1, your payment history. Your payment history is defined by credit bureaus as making your payments on time. If you are only going to do one thing out of this video and only take one thing out of it, then I hope that you will take away that your payment history and making your minimum payments on time is the most important single thing that you can do to drive and improve your credit score. Number 2, your credit card usage, or in banker speak, we used to call this your credit utilization. The credit bureaus take a look at the overall limits that you have available, meaning how much credit do you have available versus what percentage of your credit are you actually utilizing by carrying balances. So for example, to figure out your credit utilization, let's say hypothetically speaking that you had $1,000 on one credit card available as a credit limit. And let's say that you had a $100 balance that you were carrying on that credit card. If we look at that, we would say that your credit utilization would be 10% of your overall credit limit. As your balances increase on your credit cards, this is where stress comes from in people's financial lives. Go ahead, pay those balances off every month by the statement due date. And if you're doing that, you can collect all the rewards points, all the bonuses that come from the credit card companies without paying any of the fees that come through interest payments and through fees. Number 3, derogatory marks. Derogatory marks are described as things like liens, collections, foreclosures, bankruptcies, or civil judgments. Derogatory marks actually combines with your payment history to make up 35% of your overall credit score. So derogatory marks are critical just as payment history is critical, but it is not quite as impactful as your payment history and making your payments on time. Next, we'll move into the medium impact category. This medium impact category will make up 15% of your overall credit score. Number 4 is credit age. Credit age is the average age of the accounts on your credit report. Essentially, the longer age of the account, the more stable that account is viewed as a record on your credit report. The age of your credit is a signal, just as maturity is a signal in normal life. When it comes to enhancing your credit age, is to leave your oldest accounts open on your credit report. Now, That is not the same thing as saying to max out balances or to even use these items, but when I say leave them open, you don't have to utilize them for credit. It just helps if you leave these accounts open. That way, those items are increasing the age of your credit report. If you have something that is sitting there without a balance that's not costing you a significant amount of money, then my recommendation here is to leave your oldest accounts open. That way you improve your age and therefore you improve your credit score at the same time. Now let's move into the low impact items on your credit report. These low impact items make up 20% of your overall credit score. First off, in the low impact category, we have number 5 on our list, type of accounts. In banking, we call this your credit mix. Your credit mix is basically a view of the type of accounts that you have open and closed on your credit report. When we think about a credit report, the type of accounts matters. So for example, a secured credit card where you go to the bank and you say, here is $500 cash as collateral for a $500 credit limit, is not the same risk of going to the bank and saying, I want a loan for $300,000 to buy a business, for example. These are two polar opposites in terms of risk, meaning the scale, the size of the loan, and both in terms of collateral and risk of repayment on that loan. Therefore, the different type of accounts that you have, they impact your credit score as well. When you think about sort of the hierarchy here of accounts, the best possible thing that you can have on your credit report is a mortgage. A mortgage is the highest level of responsibility when it comes to credit, and it is also typically the most safe of all of the things on a credit report because that is where folks live. So it is the least likely for folks to stop paying on. So when you think about this list, kind of working down the list, it is mortgage at the top and credit cards all the way at the bottom, and everything else falls into the middle in between those two items. And number 6, hard inquiries. Hard inquiries is defined as the number of times that your credit is pulled for an application. There's a lot of confusion when it comes to this particular category and a lot of misinformation out there. So to clear this up, there is a thing called a soft credit pull and a hard credit pull. So for example, when you apply for a mortgage, you are applying for credit. That is you sitting down and throwing your name in the hat and applying to have an account opened up in your name. That is considered a hard inquiry because you are going there and you are applying. A soft inquiry can be things like your utility company randomly checking over a period of time after you've already established an account with them just to see what your credit score is. The hard inquiry comes with a lot of information, your name, your full profile, and a summary of all of these 6 categories of your credit. Whereas a soft inquiry does not come with much information. It's typically relegated to your credit score and some very basic information about you. The hard inquiry is going to be specifically when you are applying, and that is the one that impacts your credit report. And the soft inquiry does not impact your credit report and is simply just a maintenance mechanism for companies that do not need your full credit report or an application. You want to make sure that you're limiting your hard inquiries, applying for a mortgage, applying for an auto loan, applying for a personal loan, applying for a business loan. These things are hard inquiries and definitely impact your score. So those things should be spaced out. If you're going in and you're doing these things all in bulk, it is a clear indication that maybe there's a struggle going on there. And so you want to be doing these things spread out And keep in mind that the hard inquiries do fall off over time. So those are the 6 factors that go into your credit report. The bonus that I have for you today, and the best recommendation I can give you, is to go sign up for Credit Karma. Credit Karma is not sponsoring this video, but I use them personally and have used several different reporting agencies and even have sold several of these as a banker. And I can tell you Credit Karma is the only one that is 100% free, does not hurt your credit report in any way for you to monitor your credit on a daily, weekly, or monthly basis. However often you like, you can get real-time updates at any moment right through the Credit Karma app. And it will also give you monitoring and alerts. That way, if anyone uses your credit fraudulently to open up an account, you will get notified in real time when it happens. That way you can address it. Best of all, Credit Karma also gives recommendations about how to improve your credit score. I have used this app for at least 5 years, and I can tell you it is robust. It is the best free option out there. I'll leave a link in the description. Guys, thanks so much for joining me today. If you got value out of this video, do me a favor, go ahead, smash that like button. It really helps out the channel a lot. And for more videos on how to win with money, go ahead, hit that subscribe button. Also, consider adding me on Instagram, where my posts are pretty much daily. And thanks so much for all the love and support, and I look forward to seeing you on the next one.